Every nation on earth can print unlimited money. Every central bank has the same power. So why isn't everyone rich? Because printing money was never about making you wealthy. It was about keeping you poor while pretending to help. Think about it. Since 1971, when the United States severed the dollar's last link to gold, governments have had the power to create money with a keystroke. No mines to dig, no vaults to fill, just numbers added to a screen. And they've used that power aggressively. The global money supply has exploded. Trillions created during the 2008 financial crisis, trillions more during the pandemic. Central banks in Europe, Japan, the United States, all running the same playbook. If money is the problem and governments can create infinite amounts of it, why hasn't poverty been solved? Why are housing costs crushing families? Why do wages feel like they're shrinking even when the numbers go up? The answer is brutal, and it's been hiding in plain sight for centuries. Printing money doesn't create wealth, it transfers it from you to those who get the money first. This isn't a new trick. In the 1700s, an economist named Richard Cantillon noticed something that governments didn't want people to see. When new money enters an economy, it doesn't spread evenly. It flows like water downhill, and those at the top drink first. Here's how it works. When a central bank prints money, where does it go first? Not to your paycheck. Not to the grocery store. It goes to governments, to banks, to large financial institutions. They receive it as loans, as bond purchases, as liquidity injections, and they spend it immediately before prices have adjusted. By the time that money trickles down to ordinary workers, to small businesses, to savers, it's too late. Prices have already risen. The cost of housing, food, energy, everything you need has gone up. You're paid in the new money, but you're spending it in the new prices. You got the money less, so you pay the most. This is called the Cantillon Effect, and it's the reason why every round of money printing makes the rich richer and leaves everyone else further behind. It's not a bug of the system, it's the core feature. History has run this experiment over and over, and the results are always the same. Take Rome. In the 3rd century, the empire faced endless wars and rising costs. Instead of raising taxes, which would have sparked revolt, emperors began debasing the currency. The silver denarius, once nearly pure, was mixed with cheaper metals until it was barely silver at all. More coins in circulation, same amount of real value. Prices exploded, wages couldn't keep up. The soldiers who defended the empire were paid in coins that bought less bread each year. The empire rotted from within, and inflation was the silent blade. Fast forward to Weimar Germany in the 1920s. After World War I, the government owed massive reparations and faced economic collapse. So they printed, and printed, and printed. By 1923, prices doubled every few days. Workers were paid twice a day because their morning wages were worthless by evening. People carried money in wheelbarrows, not because they were rich, but because it took that much paper to buy a loaf of bread. Life savings evaporated. Pensioners starved. The middle class was destroyed. But here's what most people miss. Not everyone suffered. Those who owned real assets, land, businesses, foreign currency, came out ahead. Those who held paper marks were wiped out. Once again, printing money didn't lift everyone. It separated winners from losers, and the losers were always the ones who trusted the system most. Now let's talk about today. After the 2008 financial crisis, central banks around the world launched quantitative easing, a polite term for printing trillions of dollars. The justification? To save the economy, to prevent collapse, to help ordinary people. And what happened? Stock markets soared, real estate prices exploded, the wealthy who owned assets saw their portfolios grow. But wages for ordinary workers? Stagnant. Savings accounts? Earning near zero interest, losing value to inflation every single year. The pandemic made it even worse. Governments printed more money in 2 years than in the previous 2 decades. They called it stimulus. They said it would help you, and some of it did, briefly. But the real winners were asset holders, corporations, and financial institutions who received the money first and bought up everything before prices adjusted. Meanwhile, you watched rent go up, groceries get more expensive, gas prices spike. You were told this was economic recovery. But recovery for whom? Here's the truth. Every time the government prints money, it's a silent transfer of wealth from your pocket to theirs. Your savings lose purchasing power, your salary buys less, and those at the top, the ones closest to the money printer, get richer. Governments will never tell you this. They'll talk about growth, about stimulus, about helping the middle class. But the mathematics are merciless. When the money supply grows faster than real productivity, inflation is guaranteed. And inflation is a tax, an invisible one that you can't vote against, can't protest, and can't escape. It punishes savers. It rewards debtors. And since governments are the biggest debtors of all, they benefit the most. This is why they love inflation. It reduces the real value of their debts. It makes billion-dollar deficits easier to manage. It keeps the system running until it doesn't. So where does this end? History gives us three options. Option 1, the system inflates slowly, eroding wealth over decades. This is the best-case scenario where purchasing power declines gradually enough that most people don't realize they're being robbed. Option 2, the system breaks suddenly. A shock, war, pandemic, financial crisis exposes the fragility. Confidence collapses. People flee into real assets. Currencies lose value rapidly. This is the Weimar scenario, the Venezuela scenario. Rare but devastating. Option 3, reset. Governments restructure debt, revalue currencies, or introduce new monetary systems. This has happened repeatedly throughout history, from Rome to Bretton Woods to Nixon's gold shock in 1971. It's a controlled collapse dressed up as reform. None of these options are good for ordinary people. In every case, those holding paper wealth lose. Those holding real assets, skills, land, resources, hard money, survive. So what should you take from this? First, stop believing that money printing helps you. It doesn't. It never has. It's a tool to transfer wealth upward while making you feel like the system cares. Second, understand that your savings and cash are melting. Slowly, invisibly, but surely. Every year of inflation is a year of loss. Holding cash long-term is not safety. It's slow financial suicide. Third, focus on real wealth. Assets that hold value when currencies don't. Skills that produce value no matter what money is worth. Knowledge that lets you see through the illusions. These are the only protections that history has proven reliable. And finally, stop waiting for the system to fix itself. It won't. It's designed to benefit those who understand it and quietly drain those who don't. If you don't learn how money really works, how it's created, who profits, and who pays, you will always be on the losing side. Every nation prints money. Every government promises it's for your benefit. And every time the result is the same. The rich get richer, and you work harder just to stay in place. This isn't conspiracy. It's history. It's mathematics. It's the design of the system. And until you see it clearly, you'll keep playing a game you were never meant to win. History doesn't repeat, but it rhymes. And if you don't understand the pattern, it will crush you all the same.